Time now to spotlight semiconductors and what a China-U.S. trade truce means for the space. Joining us now for insight, we've got Ben Emons, Chief Investment Officer and founder, FedWatch Advisors. Ben, it is good to see you this morning. All right, I want to get, first of all, your broad take. I see you have a big smile on your face. A lot of the market participants I've seen today have big smiles on their face because I think going into this weekend, while many expected some progress, I don't know the degree that we were expecting. I don't think any really could see that coming. What's your overall take?
Yeah, I think that's right, Diane, and good morning. Yeah, it's a day to smile, but I think really because it wasn't a surprise this morning to see this joint statement really directed at tariffs to bring them down from its really high levels to 10%, or in the case of China to 34%, as Bessent said. Nonetheless, it's a huge de-escalation, and we're leading out to sort of a phase of truce for the next 90 days. And the way the market's responding to it, as you can tell from the chart, it's already in a V shape, right? So it's kind of implying a V-shaped recovery, but also that's what it's really about. It's about the economy. We're going to get probably within the next week or so trade really to restart between the US and China, because right now it's completely frozen. And that will really, I think, really quickly impact the economy. I think that's what the market is saying today. Lower tariffs means more trade, and therefore kickstarting of on both sides in the economy.
Okay, certainly seems to be the case. All right, I'm curious to know your thoughts on this because you call this trade truce, quote, a win for all U.S.-based semiconductor stocks. So you got names like Intel, AMD, and the king of AI, NVIDIA, rallying today. You even got Apple, Amazon. Those obviously aren't the, semis, but they are logging wins today, Meta as well. What's your read-through on why it's a game changer for those?
Well, I think what Bessent said this morning was about strategic decoupling. So it's not like the big decoupling that we've had from the trade war previously, but more like strategically that the US is negotiating with China how to get their supply chain on chips particularly moved to the US. And that's actually a win for the US companies because, for one, you're not relying on the supply chain elsewhere. Two, it also is about competition, right? We actually control things within the US. The whole DeepSeek story earlier this year was suddenly making the competition in chips very, very alive. And actually this sort of strategic decoupling by having chip production here, controlling the price here, is actually, I think, a competitive advantage to these companies. Lastly, it's, I think, also just about the reduction of uncertainty overall. The market very negatively responded to the reciprocal tariffs, really because of semiconductors. That was looked at as like, it's one thing to stop trade on toys and game consoles and apparel. It's another thing to actually freeze the supply chain and therefore cause a huge ripple effect in the economy. That's really particularly related to semiconductors. So this is why this is an important change today. The strategic decoupling, as Bessent said, I think that's the way to go from here. So I think this is an upside for semiconductor stocks.
So it's an upside for semiconductors. You've noted this rebound in semis, but also we're seeing a rebound in small caps, over in consumer discretionary. We're seeing a big rally in Amazon right now. It's up more than 10%. Is this just a relief rally, or is there something more meaningful that you're watching to when it comes to the pattern?
Well, you're right about that. There is a relief in there because, again, like if you're taking the tariffs down so much, and you're getting trade restarted between the US and China. That's, I think, the relief part. But it's that strategic idea. And I think what I mentioned too is that you have the transportation index, for example, is up big too today. Because that's where I think the pain pressure was immediately for the economy, right? All the transportation, shipping, logistics was just sort of frozen as well as we stopped trading with China. So I think it's a relief rally today. You're going to get some profit taking, I expect. We have CPI tomorrow. That probably will be maybe a catalyst for some profit taking. We're getting the Fed back in focus because now all the trade noise is behind us. And we had a lot of Fed speakers too. So people will look at these reasons to say, good relief rally, take some profit and then see what happens from here. Because we're getting 90 days of talks, right? And it could be still, moments that things could derail to an extent. And we think of 2019 that did happen at that time.
So you make a great point because you said trade war is behind us, but that doesn't mean there won't be any trade tensions, right? And, it could still be kind of a tightrope walk. And even when you talked about that what it seems to be a tariff ceiling of 34% and then a potential floor. So there suggests there could be this range. How do you think markets are interpreting that?
I think for now the markets are interpreting two things. One, that 145% where we were at before, that was really the extreme, and it's not likely to come back unless you're getting a total, war again that starts to escalate for whatever reason it happens. But that's very unlikely. Two, that 34% may indeed not be the number where they get out of, it may be lower. Now, it's interesting to see that actually the rate before the April 2nd was somewhere in between, I think it was 10 and 15% or so on Chinese goods on average. So we may go back down to that number, but that is for the markets at least a point of that. This will lead China to reopen its markets. This will lead to the strategic decoupling of the supply chain. This will lead to, I guess, a better trade balance between the US and China. I think that's what the market is saying today. It will take time because it's not something that happens in the next week, but it's definitely a long-term change, I think, here that's happening. Despite all the noise that we had and all the tension we had about those high tariffs, lastly, the high tariffs are no longer in place. This also means for the Fed something of a different story, right? Powell has been warning, if you're getting persistent high tariffs, you're getting inflation problems. So that seems to be a bit off the table too. You could tell from gold, you could tell from the rate cuts. The stagflation story is kind of behind us now too.
So I want to dig into your point about strategic decoupling that was mentioned, obviously. Does it feel like the market is pricing for that? Because it seems like it feels like there's more of a push towards, or a view towards a recoupling versus a strategic decoupling. How do you reconcile, or how should investors, kind of reconcile that? Because I feel like it's like a tightrope, right? And on the tension is here, and on one side is the tariff policy and trade policy, and the other side is sentiment. How should investors reconcile that?
Yeah, I think it's good to kind of dissect the two from the sentiment versus what the actual impact will be. So you're seeing this gap between the Chinese tech stocks and US tech stocks since the start of this year. So US tech stocks have underperformed Chinese tech stocks really because of that supply chain issue as a result of high tariffs. So that's your strategic decoupling, so to speak. I guess the recoupling will be that if we getting a bit of relief here further from here, as the news starts to trickle in about this final agreement, that US tech stocks will catch up to Chinese tech stocks. In fact, I think US equities in general will catch up to foreign equities overall, because people also looked at the trade war like brand damage, and people can trust the US. I think that too is a bit faded in the background. So I think the strategic decoupling was priced into US tech stocks, and the performance of US tech stocks will be recoupling the way foreign tech stocks are.
Ben, what are you looking for on when it comes to CPI tomorrow? As you mentioned, we get it. What are you expecting to still see a hotter index?
It may be slightly hotter, but we had a big drop in energy prices of the past month, ever since the trade war started on April 2nd. So that will really affect the headline CPI number. But then again, there were tariffs in place since February 10th, and they've moved up higher from then. So there will be some impact on retail type products, and think of apparel, think of other types of that type of items against rents that have continued to soften. So net, the picture is that CPI will be a little stickier, but I don't think it's red hot. What will be important, I think, from here is that the market was pricing in a significantly hotter CPI in the next 3 months. I think that's maybe changing if these tariffs really stay low and go down even further. I think for tomorrow will be sort of like a number that's, I think, fairly in line, maybe not as much of an upside surprise, but definitely showing some upside pressure from the tariffs.
And Ben, how much does it matter in the context of the news that we've gotten between the U.S. and China?
Well, it actually doesn't matter per se, but I think for the Fed, it does matter that these high persistent tariffs, what Powell was talking about, you're talking about 445%, those are not going to happen anymore. Those are not going to be persistent anymore. And that will probably not lead then anymore to this big inflation shock that people were fearing, or the stagflation. I think that's the story for tomorrow with CPI. It will reflect a number that's not really a stagflation number. So for that reason, markets will probably be relieved if it comes in line with expectations, or even if it's softer. And on the other hand, we have inflation, right? It's not necessarily that it's going to go all the way down. So we have to keep dealing with a Fed that has to keep its eyes on the ball of inflation, that it can't just cut rates so aggressively. Therefore, these rate cuts are being pushed out in the future.
And Ben, knowing what we know now, do you think the Fed made the right decision? Because obviously there were all these calls for the Fed to cut rates at its most recent meeting. They adopted that wait and see approach. Do you think the Fed now, given the benefit of hindsight, made the right decision?
I think it probably did, because the way the market has digested the tariff shock and then subsequently started to recover as the news started to come in, that the Fed really took an independent position, saying, look, this is an administration issue. They have to communicate to markets instead of us, right? That this deal will come along and things will resolve itself, which it now did. So the Fed indeed made the right call not to do anything during the distress moment. However, the distress was so significant that I think the Fed was pretty close to pulling the trigger on some sort of liquidity measure if that were to be a more disastrous scenario. There's a disorder in the market. So I do think the Fed will continue to monitor that carefully, that the sensitivity of markets is very high to the tariff story, that if it does turn back to a negative, that the Fed has to watch what markets are doing, because of, that it could lead to major financial conditions tightening and disruption. I think what the Fed did do right was not to respond to political pressure and to simply say, we don't need to cut rates here because the economy is collapsing. This is a dispute that is leading to a temporary disruption. So the Fed was right.
Yeah, the transitory comes to mind. All right, that's Ben Emons, founder and chief investment officer, Fed Watch Advisors. Thank you, Ben.